What's going on, guys? Vitaly here with Moskalenko Brothers, and in today's video we have a lot to talk about. There was so much happening in the world of finance last week, and this week JPMorgan acquired First Republic Bank, Fed announced another rate hike, and job report came in better than expected, and so did the inflation data a few days ago. You know, this is why I follow business and finance, and it's my choice of entertainment. There's always so much action, unlike sports. Lately in the world of finance, we've been getting breaking news almost weekly, either on some crypto scam or some company collapse. Remember the saga of Sam Bankman-Fried? Yeah, this guy. It just happened recently, but it's an old story because the Silicon Valley Bank collapse was a lot bigger story, which also happened recently, but now it's also an old story because we now moved on to the story of First Republic Bank collapse. And now the story is also getting old. See what I mean? Who knows what the rest of the year has in store for us, and I can't wait to find out. Today we are primarily going to cover the deal between JP and First Republic. Before we do that, I just want to remind you that this video is sponsored by no one. So that's that, but hey, maybe one day. Therefore, if you could take a moment to like and subscribe, that will help the robots to spread this video to people like you who are perhaps into similar topics as you. Without any further delay, let's begin. Remember a couple of months ago when Silicon Valley Bank collapsed in a matter of hours, and it was declared to be the second largest bank to collapse in the US history? Well, it's no longer the second largest, it's actually the third largest. The second largest now would be the First Republic Bank, based on its asset size of $212 billion versus $209 billion for Silicon Valley Bank. It now feels like a competition, which bank will be next and whether it will be bigger than Washington Mutual, which collapsed in 2008 and still holds the #1 title with its assets back then valued at $307 billion. If you haven't seen our previous video covering the collapse of the Silicon Valley Bank, you should definitely check it out because it will give you a greater context, since Silicon Valley Bank was one of the first dominoes that pushed the First Republic Bank off the cliff. If you followed SVB's downfall closely, one of the fascinating things that unfolded was customers withdrawing over $40 billion from the bank in just a few days. One of the reasons it was so fascinating is because that was perhaps the first time we saw a smartphone-enabled bank run, meaning that people didn't necessarily have to stay in line at the bank to get their money out, but instead were able to do so and do it fast using their phones and mobile banking apps. The other fascinating part when SVB was burning is that while the Treasury Department and the Federal Reserve were crafting ways to stop the spread of the banking crisis, the wildfire certainly spread to other banks, and not just regionals but worldwide. A full-blown panic was impossible to contain, and among other banks that suffered, First Republic Bank suffered the most, hence why JP was able to acquire it. The truth is, SVB wasn't necessarily the first domino that knocked the First Republic Bank, but rather the last nail in the coffin. First Republic Bank already had its issues, and just like SVB, the bank's downfall was caused by a chain of events that started when the Federal Reserve's decision to increase interest rates at fast pace. This led bank depositors to look for better investment opportunities elsewhere, forcing the bank to offer higher returns to keep its customers, which it couldn't afford. Unfortunately, this came at a time when rising interest rates were causing decline in the value of the bank's mortgage portfolio, leading to financial losses. In retrospect, the bank realized that this was a problem that it should have anticipated, but at the time it was confident that it could weather the Fed's inflation-fighting policies. The collapse of First Republic was a shock, considering its reputation as a big bank with small-town values. The bank's philosophy was based on the idea that high-end clients preferred personalized services over higher interest rates on their deposit. First Republic lured customers by offering minimal interest rates on deposits and utilizing the funds to finance mortgages for luxury properties. The more deposits the bank attracted, the more loans it could extend. As a result, borrowers paid an average interest rate of 3.03%, which was significantly higher than the partly 0.12% that the bank offered its depositors. In a world of low interest rates, this traditional model adopted by First Republic proved to be very profitable. The bank's profits quadrupled over the decade. It extended rapidly and became one of the America's 20 largest banks, with its valuation outpacing industry giants like JPMorgan Chase and Bank of America by several measures. But as we all know, good times never last forever. The combination of rising interest rates and the bank's inability to hold onto its depositors, let alone attract new ones, and the risk taken with its mortgage portfolio all put enormous pressure on the bank. The sudden increase in yields on treasuries and money market accounts, providing up to 4% return, made it difficult for the bank to retain its rich customers, even with their superior customer service. High net worth individuals were reluctant to hold onto checking accounts that gave next to nothing in terms of returns. As of the end of 2022, the bank accumulated $176 billion in deposits, out of which 68% exceeded the $250,000 insurance limit guaranteed by the Federal Deposit Insurance Corp. This essentially meant that 68% of the customers had no assurance of getting their money back in case of the bank's failure. Deposits made up 92% 92% of the bank's funding, highlighting the substantial reliance of the bank on customer deposits. First Republic Bank experienced a staggering 13% increase in deposits in 2022, but it came at a steep cost. In the fourth quarter of that same year, the bank paid a whopping $428 million in interest on deposits, a stark contrast to the $20 million paid out just a year earlier. The hike in deposit costs was a severe issue to the bank since its profit came primarily from low-yield, fixed-rate mortgages which have an extended maturity period. In 2022, over half of the First Republic's loans were residential mortgages, which had an average interest rate of 2.89%, and as the interest rates increased, the bank's mortgage portfolio declined by some $22 billion in market value. As Federal Reserve began raising rates, customers of First Republic Bank were no longer satisfied with minimal interest rates earned on their deposits. The movement of funds from the bank started gradually, but it picked up momentum until all at once, the bank experienced a mass exodus of its customers' deposits. Customers pulled about $100 billion in deposits in March, and by April 25th, bank's price per share was down by 92%. All this is just the first half of the story. The other half is where JPMorgan Chase comes in with a lifeline. In a deal negotiated by regulators, the largest bank in the United States, JPMorgan, will acquire the substantial majority of First Republic's assets, including $173 billion of loans, $30 billion of securities, and $92 billion of deposits. As the saying goes, the big get bigger and the small go out. Here's another saying, never let a good crisis go to waste. JPMorgan Chase has done just that. In fact, this type of crises provide the perfect opportunity for larger banks, the banks that are too big to fail, to expand their presence and gain market share. This is not the first time JPMorgan Chase has taken advantage of such situation. In 2008, during the financial crisis, JP acquired Bear Stearns and Washington Mutual to become the largest bank in the United States. This time is no different. The bank will be adding $92 billion of deposits to its already sizable deposit base and expanding its presence in the lucrative wealth management business. JP Morgan's deposits have skyrocketed by 62% from 2019 to $2.2 trillion. The move on First Republic resulted in a deposit increase of $92 billion, rapidly adding to JP Morgan's massive deposit base. In comparison, 4% may seem like a slight increase. Remember, it's being compounded on top of an already enormous existing base. If Citigroup's deposits jumped by $90 billion, it would boost their total by over 11%. This increase in deposit funds is equivalent to 3/4 of JP Morgan's deposits from 2021 to 2022, and is significantly higher than their average annual growth rate of $56 billion from 2014 to 2019. This is monopoly done right. That's how you do it. Become so big that you are systemically important and you will never be allowed to fail. On top of that, acquire the competition. After all, who will be there to stop you? No one, because the same regulators and government officials who advocate against monopolies are the ones who negotiate the deal. In 1994, a law was passed that allowed banks in the United States to merge across state lines with minimal restrictions. However, to prevent the big players in the industry from becoming even larger and more powerful, this measure placed a limit on each bank's total shares of nation's deposits to 10%, with a 30% limit within state. However, the cap only applied to acquisitions, and the large banks that exceeded the threshold could compete for new deposits via organic growth without any limitations on their overall deposit share. By 2014, the three largest banks in the country, JPMorgan Chase, Bank of America, and Wells Fargo, had grown to exceed this threshold by taking over other institutions such as Washington Mutual, Merrill Lynch, and Wachovia in the financial crisis of 2008. Consequently, this rule barred the three giants from merging with any other rival banks for a decade. In the 1994 legislation, there was, however, a loophole that allowed a waiver to be granted to buyers who stepped in to rescue failing lenders that the FDIC was ready to shut down. Simply put, if a bank holds more than 10% of the nation's deposits, that bank is barred from acquiring any more banks. However, if a failing bank falls into the hands of the FDIC, then a waiver can be granted to the winning bidder, regardless of the size. This is exactly what happened with JP's acquisition of First Republic Bank, and this loophole has served them very well. That's all I have for you today. Thank you for your time as always. Stay safe and stay informed.